How to avoid paying capital gains tax on inherited property in CA. So you've just inherited a beautiful home right here in Orange County. It's an incredible, life-changing gift, but it also comes with one big scary question. When you decide to sell, are you about to get a massive six-figure tax bill from the IRS? In a market like OC, where home values have gone through the roof over the last few decades, that's a completely reasonable fear. The gap between what the home was originally bought for and what it's worth today could easily be millions of dollars. But before you panic, before you even think about calling a real estate agent, and definitely before you sign a single document, you need to know about a concept that is the golden key to this whole situation. It's called the step up in basis. Seriously, understanding this one thing could legally erase hundreds of thousands or even millions of dollars from your tax bill. In this video, I'm going to show you exactly what it is, how it works, and the key strategies you can use to avoid paying capital gains taxes on your inherited property here in Orange County. The anxiety you're feeling is real, especially here. We've seen it all. A home bought in the 70s or 80s for less than $100,000 can easily be worth 1.5 or 2 million today. The appreciation is staggering. And your first thought is probably the government is going to want a huge piece of that profit. That profit, the difference between the purchase price and the selling price, is exactly what capital gains tax is all about. Quick reminder, subscribe if you want simple weekly guidance on inherited homes, trust, and probate. So let's get into the single most important concept that will be the foundation for every strategy we talk about. Capital gains tax is calculated on the gain. Simple enough, right? The gain is your sale price minus your cost basis. For a normal home sale, the cost basis is what you originally paid for it, plus the cost of any big improvements. Let's imagine your parents bought a house in Newport Beach back in 1985 for $200,000. They put in a new kitchen and a pool over the years for another $100,000. Their cost basis would be $300,000. If they sold it today for $2.5 million, their taxable gain would be a whopping $2.2 million. Now you think that when you inherit the house, you also inherit that $300,000 cost basis. And this is where the magic happens. This is where the tax code hands you a massive advantage. Under federal tax law, Section 1014 of the Internal Revenue Code, an inherited asset gets what's called a step up in basis. This rule says that your cost basis as the heir isn't the original purchase price. Instead, your basis is the step up to the fair market value of the property on the date the original owner passed away. Let me say that again because it's the whole ballgame. The property's cost basis resets to its market value at the moment of inheritance. All those decades of growth, that huge gap between $200,000 and $2.5 million, are essentially wiped clean for capital gains tax purposes. Let's look at our example again. Original purchase price, $200,000. Fair market value at date of death, today, $2.5 million. Your new cost basis in the property is now $2.5 million, not $200,000. You are not on the hook for the tax on that $2.3 million of growth that happened during your parents' lifetime. This single rule is the difference between a potential six-figure tax bill and a tax bill of zero. This is why one of the first and most critical things you must do is get a formal date of death appraisal. This isn't a Zillow estimate or a casual number from a friend in real estate. You need to hire a state licensed certified appraiser to create a detailed report establishing the home's value on the date the owner passed away. This document is your proof for the IRS. Without it, the IRS can challenge your basis, leaving you in the very weak position of trying to prove a property's value from the past. In California, a probate court might assign its own appraiser, called a probate referee, which just goes to show you how important this formal valuation is. Now, some of you might have heard about an alternate valuation date, which allows an estate's executor to value assets 6 months after the death. Just know this is pretty rare. It has to be done for the entire estate, not just the house, and it's usually only done if the estate's overall value has dropped to reduce federal estate tax. For almost everyone watching, the number that matters is the fair market value on the date of death. Now that you get this fundamental concept that your basis is reset to today's value, let's look at the strategic doors it opens for you. With your new stepped-up basis in hand, you're in the driver's seat. You have a few paths you can take, and each has its own pros and cons. First, the most straightforward and often the most tax-efficient strategy is to sell the property pretty quickly after you inherit it. Why? Because your cost basis is the fair market value on the date of death. If you sell the home within a few months, chances are the market value hasn't moved much. Let's run the numbers. Date of death appraisal value. Your stepped up basis, $2.5 million. You sell the home 3 months later for $2.5 million and $10,000. What's your capital gain? It's not the millions in appreciation since 1985. It's only the $10,000 the property appreciated after you inherited it. So you only owe capital gains tax on that tiny $10,000 sliver, and if you sell it for exactly the appraised value, your capital gains is zero. The tax bill is zero. This is by far the simplest path. It gives you immediate cash and makes it easy to split the inheritance between multiple heirs. It lets you avoid the headaches of being a landlord or the cost of maintaining a property you don't live in. For most families, especially when siblings need to divide an estate, this is the cleanest solution. The main thing to watch here is the market. If Orange County real estate is heating up, waiting a few months could mean a slightly bigger gain. If the market dips, you might even sell for a smaller loss, which can sometimes be deducted. But generally, a quick sale is the most direct way to use that step up in basis and walk away with little to no tax hit. So what if you don't want to sell right away? What if you always dreamed of living in the family home? This brings us to another powerhouse of the tax code, the Section 121 exclusion, also known as the primary resident exclusion. Here's how it works. If you own and use a property as your main home for at least 2 of the 5 years before you sell it, the IRS lets you exclude a huge chunk of capital gain. For a single person, you can exclude up to $250,000 of gain. For a married couple, filing jointly, you can exclude up to $500,000 of gain. Think of this as a 1-2 punch for tax savings. The step up in basis erases the gain before you inherited the home. The Section 121 exclusion can then erase the gain that happens after you inherit it. Let's say you inherit Newport Beach house with a step-up basis of $2,500,000. Instead of selling, you move in. You live there for 3 years, and during that time, the Orange County market keeps climbing, and the house is now worth $2.8 million. Sale price, $2.8 million. Your stepped-up basis, $2.5 million. Your capital gain, $300,000. If this were just an investment property, you owe taxes on that full $300,000 gain. But since you live there for over 2 years, you can use the Section 121 exclusion. If you're single, you shield $250,000 of the gain, meaning you only pay tax on $50,000. If you're married, you can exclude up to $500,000. In that case, your entire $300,000 gain is wiped out. Your federal capital gains tax bill is $0. To qualify, you have to meet both the ownership test and the use test. Here's a crucial point. For an inherited property, you can't tack on the time the person you inherited from owned it. The clock starts with you. You must own the home for at least 2 years, and you must use it as your primary resident for at least 2 years in the 5-year window before the sale. This is a fantastic strategy if you generally want to live in the home, but you have to actually live there. The IRS checks things like voter registration, mail, and your driver's license to be sure. Or 3, all right, what if you don't want to sell and you don't want to live there, but you love the idea of owning Orange County real estate? Maybe you want to be a landlord. This leads us to our third major strategy, the 1031 exchange. It's critical to know that a 1031 exchange doesn't eliminate tax, it defers it. This is a tool for investment properties. The whole point of Section 1031 is that if you sell an investment property, you can kick the capital gains tax down the road, as long as you reinvest the money into another like-kind investment property. Here's how you do it. You inherit the home and get your stepped-up basis. You decide to rent it out for a year or 2, which officially makes it an investment property. Let's say it appreciates another $100,000 in that time. Now you decide you don't want to be a landlord in Newport Beach anymore. You may want to buy a duplex in Costa Mesa. Instead of selling the Newport Beach house and paying tax on that $100,000 gain, you start a 1031 exchange. Be warned, the rules are incredibly strict. 1, like-kind property. You have to swap for another real estate held for investment. The good news is that like-kind is super broad. You can exchange a house for an apartment building, raw land, or a commercial property. 2, strict timelines. From the day you sell your property, you have only 45 days to identify potential replacement property in writing. And you have a total of 180 days from that sale date to close on the new property. These deadlines are absolute. 3, use of qualified intermediary. You can touch the money. The sales proceeds must be handled by a neutral third party called a qualified intermediary QI is that cash hits your bank account even for a second, the exchange is blown and tax is due. Follow these rules and you can roll your entire gain into a new property and then another and another. People call the swap until you drop strategy. You can keep deferring these gains for your entire life. And the best part, when you pass away, the properties you own will go into your heirs, who will get their own step up in basis, potentially wiping out all those deferred taxes forever. It's a powerful way to build generational wealth, but it's an advanced strategy that requires a good CPA and QI. Last, number 4. This isn't really a standalone strategy, but it's something you should use with any sale to shrink your final tax bill. When you sell a property, your taxable gains is based on your net proceeds, not the sale price, and you get to deduct a whole bunch of selling expenses. Think of it like this. Sale price minus selling expenses equal net proceeds. Net proceeds minus your stepped up basis equals your taxable gain. So what can you deduct? The list is long. Real estate agent commissions, this is the big one, often 6%. Escrow and title fees, legal fees for the sale, advertising costs, home staging fees, transfer taxes, any repairs you made to get the house ready for sale. Let's go back to our sell immediately scenario. Your basis is $2.5 million and you sell it for $2.5 million, giving you a $10,000 gain. But what if your selling costs, commission fees, etc., total $120,000? You subtract those costs from the sale price. Suddenly, you don't have a $10,000 gain, you actually have a capital loss, which can have its own tax benefits. Even if your gain was bigger, say $150,000, deducting $120,000 in your costs would knock your taxable gains down to just $30,000. This is why you have to keep records of everything. Every single dollar you spend to sell that house can reduce your taxable gains. Keep every record and every invoice. It could easily save you thousands of dollars. Everything we've just talked about, step up in basis, Section 121, 1031s, is federal tax law. It's about capital gains. Now we have to talk about a unique California issue that has nothing to do with capital gains, but will have a huge impact on your decision. Proposition 19. Proposition 19 completely changed the rules for property tax reassessment when property is inherited in California starting February 16, 2021. Before Proposition 19, a child only could inherit a parent's primary home and also inherit their parents' super low property tax bill, no matter what they did with the house. That was the cornerstone of legacy planning in California for decades. Proposition 19 threw that out. Now, to keep your parents' low property tax bill, 2 very strict rules apply. You must move in. The heir has to move into the inherited property and make it their primary residence within 1 year. If you keep it as a vacation home or a rental, the property tax will be fully reassessed to its current market value and your tax bill will explode. 2, the $1 million cap. Even if you move in, the protection is capped. You can only keep the old tax basis if the home's current market value isn't more than $1 million over its original assessed value. For transfers happening now, this exclusion amount is specifically indexed to $1,044,586. Let's do the math for Orange County example, because this is where it gets serious. Your parents' original assessed value, the Prop 13 value, $300,000. Their annual property tax is about 1% for this, so that's $3,000. The home's current market value is $2 million. Under Prop 19, you get to protect the original assessed value plus the cap. So $300,000 plus $1 million is $1,300,000. The market value of your home, $2 million, is $700,000 over that protected amount. So that $700,000 gets added to the original assessed value. New assessed value is $300,000 plus $700,000 equals $1 million. So even if you move in, your new property tax won't be based on $300,000 anymore. It'll be based on $1 million. Your annual taxes just jump from around $3,000 to over $10,000. And what if you don't move in? What if you rent it out? The property gets fully reassessed to the current $2 million value. Your property tax bill would leap from $3,000 to over $20,000 a year. This is the Prop 19 shock. That's forcing many California heirs to sell homes they wanted to keep, simply because the new tax bill makes it unaffordable. This creates a huge decision point for anyone inheriting a property in Orange County. Path A, sell the property. Your capital gains tax is likely little to nothing thanks to the step up in basis. You don't worry about Prop 19 at all. Path B, keep and move in. You might save a lot on property taxes, though maybe not as much as before Prop 19. But now you're committed, and to get that capital gains exclusion later, you'll need to live there for at least 2 years. Prop 19 is state-level property tax issue, but you have to think about it alongside your federal capital gains tax plan. They are two sides of the same coin when making your decisions. Let's talk about the biggest and most expensive mistake I see people make. Mistake number 1, gifting the property before death. This is without a doubt the most financial devastating mistake a family can make, and it always comes from a good place. The parent, trying to make things simple, adds their kid's name to the deed or just gives the house to them before they pass away. Do not do this. When you get a property as a lifetime gift, you also get the giver's original cost basis. It's called carryover basis. You completely lose the step up in basis at death. Remember, our Newport Beach house, the basis is $300,000 and the value is $2.5 million. If your parent gives you the house, your basis is now $300,000. When you go to sell it, you have a $2.2 million taxable gain. You just voluntarily signed up for a massive tax bill that could have been legal and completely erased if you had simply inherited the property. Mistake number 2, not getting a professional date of death appraisal. I can't say this enough. As soon as you inherit, hire a qualified appraiser. A printout from a website or a quick estimate from the agent won't hold up if the IRS challenges you. You need a formal, detailed report to lock in your stepped-up basis. it's a small expense that can save you a fortune later. Mistake number 3, confusing inheritance tax, estate tax, and capital gains tax. People mix these up all the time, but they're totally different. Inheritance tax, a tax the person receiving the inheritance pay. The good news, California does not have an inheritance tax. You don't pay tax just for inheriting person's total net worth when they die, paid by the state itself. The federal estate tax exemption is huge. For 2026, it's projected over $3 million and is adjusted to inflation. The bottom line, the vast majority of the states owe capital gains. This is the one we focus on. It's a tax on the profit when you sell the asset. For most heirs in Orange County, this is the only tax they need to worry about, and it's totally manageable. Dealing with multiple heirs. What if you and your 2 siblings inherit the family home together? This adds family dynamics to the financial puzzle. Each of you inherits 1/3 share, and each of you gets a step up in basis of that share. Communication is usually everything. You have 3 choices. 1, sell the property. This is often the cleanest path. You sell the house and the cash is split 3 ways. Everyone gets their inheritance, no strings attached. 2, one sibling buys out the other. Maybe one of you really wants to keep the house. That sibling can get a loan to buy out the other 2. For the selling siblings, it's just like selling their portion of the property, and they calculate their small capital gain based on their 1/3 step up in basis. Co-own as an investment. Number 3, you could all decide to keep the houses as a rental and form an LLC or partnership to manage it. This can work, but it demands a strong business-like agreement from the start. The key is to get on the same page before money has a chance to strain relationships. If this breakdown of the step up in basis and how to handle an inherited property has been helpful, do me a favor and hit the like button. It really helps the channel reach more Orange County families who are facing this exact problem. And if you have questions, drop them in the comments below. I'll try to answer as many as I can. Only, I know that this was a ton of information, so let's recap the most important takeaways. First, that fear of a giant tax bill is real, but it's solved by the step up in basis. This is your number 1 tool. It resets your cost basis to the home's current value, legally wiping out taxable gains that happened during your parents' lifetime. 2, because of that step up, you have clear strategic paths that can sell immediately and likely pay little to no capital gains. You can move in and make it your home. Using the Section 121 exclusion to shield future growth, or you can turn it into a rental using a 1031 exchange to keep deferring those taxes while you build a real estate portfolio. Third, you have to account for the California curveball, Prop 19. This law hits your annual property taxes, not capital gains, and it creates a huge financial reason to either sell the property or to move into within a year to avoid a massive tax hike. This is probably a very difficult and emotional time for your family. The last thing you need is a complex financial puzzle on top of everything else. But By understanding these rules, you are now in control. You have the knowledge to protect your inheritance, honor the gift you've been given, and making a smart financial decision for your financial future. Navigating an inherited property, especially in a place like Orange County, can feel overwhelming. The details matter, and every family's financial situation is different. If you're in the spot and need a clear path forward, I really encourage you to get professional advice. If you'd like to talk with our team, you can click the link in the description below to schedule a consultation. We can help you look at your specific numbers and make the best decision for your family. Thanks for watching.